Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
The longer we have uncertainty, the more bearish the outlook. So the longer, again, we have uncertainty, the more bearish the outlook. And we definitely have a lot of uncertainty. This is my VIX spread 3-month to spot. It is in backwardation. So yesterday we were in backwardation, but it didn't stick. So this is important because it has to actually stay below. And the reason I always look at this is just for reminders. Sometimes it can create this reflexive, actually, no, it's convexity short covering, but I don't think we're there yet. We really do need a macro trigger for that. Here, we just had massive puts that were monetized when VIX hit 65. So vol sellers were in control. This was December 3rd. We had a 3% drawdown exactly on cue. It was perfect short. Anyway, the point is that was also reflexive short covering. This backwardation actually put on 8.5% once it triggered. SPY dropped 8.5% for a total of 10%. So all the time it was dropping in this zone, it still wasn't danger Will Robinson until this went into backwardation. So I really do watch this very closely. And that means we are not out of the woods. So that's why I keep saying the longer we have uncertainty, the more bearish the outlook is. That this particular ratio says we are not out of the woods. And this is the one that I'm watching the most because this is the pattern of an H that would be very, very impactful. If we take out the 200-day, we could actually crash from oversold. So that's the kind of stuff that I look for. It's not the usual. You know that. It's not what my baseline bet. When we got back inside this wedge, I'm like, okay, that's busted. And it has continued to really help time. Remember, I used to say trounce and bounce, bounce and trounce, because I could read this stuff. So this is very important. If we start to roll over and break the 200 a day, we're going to have bigger issues. VVIX was a fabulous tell with that Bollinger Band tag. On Monday, it stopped going down on as literally that Bollinger Band tag. And that was a fabulous tell. Market was going to get some shake and bake. And then yesterday it turned red because SPY went down to that 5,500, actually broke it, but then was hanging on. I said this, it's hanging on by its fingernails like Humpty Dumpty, but I don't think today is the day it's going to fall off the wall. And we clawed back up. So where did VVIX come back down to? Support. That's it. All it did was come back down to support. So you got to break 100 decisively on VVIX for this market to move higher. And that's not what it wants to do. Look at that. It's working that too. Look at all the moving averages it's trying to get above. Look at the trend line. It got above once, came back in. It's saying, hey, I want to try that again. So VVIX is still very much bid. But that's another reason I say the longer we have uncertainty, the more bearish the outlook becomes. So this is VIX also doing its thing. It did not close below the 10-week. It got back above 1950. And then we have follow through this week. There's nothing here to kind of get in its way, but I would say 25.20 on a daily. We didn't reach that yesterday. We reached an intraday high of 24 and came back in. Literally, like any other stock, it softened and came back and did a gap fill. And that's support. So now it needs to break and roll back over. Market gets below 1929. We're back in business for the SPX higher. We're not in the mode right now. We're right in the mode of more uncertainty equals more hedging. And this is a NASDAQ 100 where I said, hey, be careful. We break this channel that we've had in place literally since the August low. And that's exactly what's happening. We've rolled over and there's nothing here. So when I say we can crash from oversold, I mean we can crash from oversold. All right, so we busted that channel. We completely busted that channel. What was the high right here? On February 19th, literally when I warned. Ironic, isn't it? But look at this. Look at this. February 19th, price was way the heck up here. And I said, nope. And also right here, look at that, right before the December 2nd one I warned. So the first round of December 2nd produced great shorts. And then the second round of warning on February 19th produced great shorts. The only reason we bounced was because Trump came out on a Sunday night and said he might relax tariffs and the market bought it, but not anymore. It's kind of like dangerous. I noticed this is Fed balance sheet. We've got TGA and all that kind of fight of making sure we have liquidity in the markets. And if you remember, we kind of came all the way down into the 13th. And then once we got back above this yellow line, market stabilized. Well, yesterday they did a little dip. So yesterday I noticed notice toward the close, even though we were still above this very, very important 5,600, and you can see this, right? Down here, we had actually done a little header, didn't break it. And so that's why I wanted to, check in this morning and see how we doing. So we got saved again, but it's getting a little nerve wracking, right? And by the way, this is a little delayed. This is not the same real time as the E-mini, but I did want to point it out. We also have the dollar and yield ratio rolling over with a big old head and shoulders. And that brings me to my intermarket analysis. Well, I will go over in length because I wrote that up as I promised and posted that this morning. In the meantime, I just wanted to let you know I'm still watched on this kind of marginal line, right? So above is bullish, below is bearish. And right now we're just marginally above it. We have shake and bake all over, right? Semis are still weak. NVIDIA hanging on that 106 line by its fingernails. Credit spreads, I talked about that yesterday. They are percolating higher. Now it's something that the equity market could fix if we have a bounce. Seriously. But it's way underpriced. Way, way, way underpriced. So that is a concern. So credit markets in the US are pricing in a much lower chance of recession than equity markets are. And something has to give. This is in a Bloomberg article, London-based AXA investment managers. I've heard it described as a gray swan risk in the market, which seems apt to me. We don't know exactly what could trigger a sell-off, but we need to tread carefully. So this is, again, Bloomberg article talking about credit spreads, how they're widening, of course, right? But they're not pricing in recession yet. But you know my charts, that's the one thing that keeps me up because it's too perky. It's just too perky. Anyway, these are so far the worst month for high yield bond returns since September of 2022 in Europe and October 2023 in the US before the Fed came out. Both of those dates, by the way, that's really important what I'm reading off to you. September 2022 in Europe and October 2023 in US. What happened in both of those occasions? US policy intervention. Fed and Treasury came out and did bazooka intervention. Both of those dates. That's the bottom in equities and bonds in both of those dates. Remember my November 1st, 2023, Fed pause and Yellen Yahtzee? You've heard this a million times. So monetary easing and fiscal spending and or quantitative easing, stealth or direct, it was all very, very instrumental in backstopping the market in both of those occasions. So what are they going to do this time? Nothing. Vicent is very clear. Don't ignore him. That's all I got to say about that. All right. So I am watching liquidity for sure. I am watching that backwardation, which could start. And as I mentioned, markets can crash from oversold. And last time we had this backwardation, SPX actually came down 8.5%. So keep this in mind. And this direction of yields is pulling down equities. Oil's a little bit soft here in the 70.5 area, but this is really the deal. So yields dumping on growth or recession risk from tariffs and trade wars is causing repricing in equities, full stop, but you know that. And then of course, speaking of, I will say it again, equities are repricing some of that fundamental picture because of the macro, and it really is recession risk is starting to get pulled forward in a lot of their assessments, but credit spreads have not reflected that. So that's your next risk for those who are in fixed income and or just equity shorts. We really have to be careful of credit spreads widening now. Dollar's a little soft. You know how I feel this is going to go down into the 102 and then 100 area. And in time, we're going to break the 100, but not today. Bonds are still getting bid up in defense. Gold is still bid in defense. Mag 7 ratio is just sitting here on a kind of support. And individually, they're of course soft. But my point is, as far as the ratio is concerned on the weekly, they're just kind of sitting there. The 10-year JGB yield is coming back down into a little, it was very extended support area. We break here. We've got lower. This is your potential inverse head and shoulder in dollar yen, but I am more bearish than bullish. So I'm waiting for this to kind of retest and break 148.8. But for right now, we are waiting on Godot, which is Trump. All right, so there is your backwardation still in play, even though the market's green right here, which makes it insanely difficult to trust it. So as long as we're in backwardation, nope. I mentioned this, it doesn't happen very often, but when we do get in backwardation, there are some funds that go to cash full stop and they wait until we get back in contango. So they avoid all of this. That was an 8.5% dump in SPY. They avoid it. So just keep that in mind that there is selling that comes comes in when this goes negative. This is advanced decline of the whole bloody market, and it's from May. And you can see, this 10 and 21 is rolling over. So it's already crossed over. And then that bounce was a beautiful rejection at the prior high, and then it dumped. Then we had our March 13th low, and then we bounced into resistance, which was a pathetic excuse for, and now we're breaking down. This is not a healthy market. Full stop. Advanced decline of NASDAQ, I said and warned, it hasn't even started yet. So this is just starting to roll over. Just starting to roll over. Plenty of room. Now, if we get a bounce in breadth, I will be like, that's really great, but we don't have any. It is waterfall cascade from December 2nd, waterfall cascade from February 19th, warning, and then we went sideways while the market went nowhere fast, and then we dumped. And it is a complete divergence. This is moving higher while price is moving lower. It's just not a good backdrop yet. We're just not ready. It's not good. And then last but not least, cumulative volume. I see just consolidation here, but it's already busted. So this long, beautiful trend, if this was a stock, it was your friend. But now that it's broken, it's not. So break up with your friend, because it's not doing you any favors. Let me repeat. Dealers are not making this market right now. Macro fundamentals, they are. So it's less powerful, lack of a better word. And most of the time, the dealers make the market. Absolutely. I don't think so right now. They can exaggerate the moves upside and downside, but they're not making the moves right now. Very big difference. Policy intervention, not in the house. Dealers, they are not as big as the money going home. And we've got VIX backwardation, and I'm going to say threatening. When you've got VIX backwardation threatening, you've got credit spreads threatening, and you've got recession risk threatening. Dealers are not in control. Meantime, bonds are bid, gold is still bid, oil is still bid. Mag 7 is attempting to have these little bounces, but we really don't have anything else of rotation besides retail, and I don't trust retail. And we're still in backwardation. That matters more. Fed liquidity matters more. Credit spreads matter more. So you know my time frame, you know my warnings. I think that this is a bear trap.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.